What's the best way for beginners to start investing online with just $100? Look, I know exactly what you're thinking right now. You're probably sitting there with just $100 in your pocket, wondering, how do I turn this into something bigger? I've been hearing about investing, but it all seems like a mystery to me. Trust me, you're not alone. It's like everyone talks about investing, but no one gives you the real no-fluff guide on how to actually get started. Well, guess what? Today we're changing that. My name is Cash Queen, and I spend way too much time thinking about how to become rich. If you're someone who struggles with saving or investing your money, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Now you might be asking, is $100 even enough to get started? And let me tell you, absolutely. $100 is actually the perfect starting point. It's not about how much you have, it's about how you use it. In fact, starting small is actually one of the smartest ways to learn the ropes and build wealth over time. But here's the thing, not all investments are created equal. Some will help you grow that $100 quickly. Others might barely budge. And some could even lose you money. So how do you figure out the best way to go? Well, 4 years ago I made the same decision. I invested $100 in 5 different opportunities. And today I'm breaking down the results. I'm going to walk you through the learning curve, the passive income potential, the tax benefits, the risk levels, and the actual returns for each option. By the end of this, you'll know exactly where to put your money to start growing it. But before we dive into the specifics, let me make one thing clear. I'm not a financial advisor. I'm just here to share what worked for me and what you can learn from my mistakes and successes. So let's get started. 1. Investing in individual stocks. Alright, let's kick things off with individual stocks. This is what most people think of when they hear investing, right? Buying shares of companies like Apple or Tesla and hoping they do well so you can make a profit. Here's the thing. Individual stocks can be exciting because they let you own a part of the companies you believe in. Learning curve high. Picking stocks isn't just about guessing which company will do well. You need to dig into the company's financial health, its leadership, and market trends. You'll also need to understand the basics of things like income statements, balance sheets, and cash flow reports. It might sound complicated, but it's not impossible. Here's an easy example. Imagine you want to invest in a company like Coca-Cola. You could check how much money the company makes each year, how much debt they have, and if they're expected to grow. Think of it like choosing a team for a sports game. You want to pick the team that has a solid track record of winning, not the one that's been losing consistently. You can also practice on an app with a demo account, using fake money until you feel confident with your strategies. Passive income potential. Good. When you own stocks, there are 2 ways you can make money. Capital gains. The stock price goes up and you sell it for a profit. Dividends. Some stocks pay you a portion of the company's profits. This is passive income, meaning you make money without selling anything. Tax efficiency. Great. If you're in the UK, you can use something like a stocks and shares ISA to avoid paying taxes on your earnings. In the US, there's the Roth IRA. But be careful, not every stock pays dividends, and not every account has tax benefits, so check the rules where you live. Risk level high. The stock market goes up and down, and if you pick the wrong stock, you could lose everything. I remember during the dot-com bubble, I picked a few great stocks, but when the bubble burst, many of my picks went to zero. That's why it's important to be strategic and not put all your money into just a few stocks. Example. So, I put $100 into Samsung. After 4 years, I checked the results, and my investment is now worth $67.76. That's a minus 32.34% return. Now, here's what most people don't realize. This could have been way worse. If I had picked something like Apple, my $100 would have grown to $170. And if it had been Nvidia, that would have turned into $908. Stocks can be hit or miss, so make sure to pick wisely. 2. Real estate investment trusts, REITs. Okay, so what about real estate investment trusts or REITs? These are perfect for people who want to invest in real estate without buying actual property. With REITs, you pool your money with others to invest in big properties, things like shopping malls, apartment complexes, or even hotels. You don't own the property directly, but you share in the rental income. Learning curve moderate. It's easier than buying a house, but you do need to understand how REITs work and the types of properties they own. No, you don't don't need a down payment or mortgage, but you do need to know the basics of how rental income works. Here's an easy example. Imagine you and 10 other people pool $100 each to buy an office building. Every month, the tenants pay rent, and you get a portion of that income. Passive income potential. Great. Most REITs pay high dividends. In fact, they're required by law to give back at least 90% of their profits to shareholders. So, as long as the REIT does well and keeps its properties rented out, you can earn a steady income. Think of it like getting rent checks in the mail, without the hassle of dealing with tenants. Tax efficiency. Great. REITs are usually tax-friendly. For example, if you're in the UK, you can hold REITs in an ISA, and all the profits are tax-free. In the US, you can use tax-advantaged accounts like a Roth IRA. Risk level. Medium. REITs spread out risk by investing in multiple properties, but they're not risk-free. For example, if the real estate market crashes or the REIT struggles to keep tenants, the value of your investment could drop. Example, after 4 years, my $100 investment in a REIT is now worth $98.59. That's a small loss of 1.41%. But I also earned $11.93 in dividends, bringing my total return to plus 10.52%. So, in this case, I'm still up. REITs may not give you the biggest returns, but they're relatively stable. 3. Cryptocurrency. Now let's talk about cryptocurrency. I know it sounds a bit like a gamble, but hear me out. Crypto is a digital currency that operates on a system called blockchain. Unlike traditional money, it's not controlled by banks or governments. Some people have made a lot of money from cryptocurrencies like Bitcoin or Ethereum, but here's the kicker. Crypto is volatile. Learning curve. Moderate. To invest in crypto, you need a wallet like a digital piggy bank, and then you'll need to pick an exchange like Coinbase or Binance to buy and sell. It's all digital, so there's a learning curve. But once you get the hang of it, it's like online shopping for coins. Passive income potential. Moderate. Unlike stocks or REITs, crypto doesn't pay dividends, but you can still earn passive income through methods like staking or yield farming. Staking is like locking your coins in a vault and getting rewarded for it. But here's the thing. Staking is risky, and if the value drops or you're on a bad platform, you could lose everything. Tax efficiency. Poor. In many places, crypto is taxed as income, and you can't hold it in tax-advantaged accounts like IRAs. That means when you sell or trade crypto, you'll likely have to pay taxes on your gains. Risk level. Very high. Crypto is wildly volatile. A coin could double in value overnight or lose half its value in a single day. It's exciting, but you need a strong stomach for the wild price swings. Example, 4 years ago, I invested $100 in Bitcoin. Now, my investment is worth $652.24, giving me a return of 552.24%. That's an insane return. But don't get it twisted, this kind of growth is rare. Most cryptocurrencies lose value, so proceed with caution. 4. Gold. Gold is an old-school investment that's been around for centuries. It's known as a safe haven investment because it holds value, especially in times of uncertainty. Learning curve. Low. Gold is one of the easiest investments to understand. You can buy physical gold, like coins or bars, or gold ETFs, which track gold prices without you owning the physical metal. Passive income potential. None. Gold doesn't give you any passive income. It's just a store of value, meaning its primary purpose is to protect wealth, not generate income. Tax efficiency. Good. Depending on where you live, some gold coins are exempt from capital gains tax. In the UK, for example, you might get a tax break if you buy gold coins like the Gold Britannia. Gold ETFs can also be held in tax-advantaged accounts like ISAs. Risk level. Medium. Gold is stable but doesn't grow much. It can protect your wealth during inflation, but it's not the best option for rapid growth. Example, my $100 investment in gold 4 years ago is now worth $140.10, a return of 40.1%. Not huge but solid. Gold is the tortoise, not the hare, and that's why it's great for preserving wealth, not chasing huge gains. 5. Index funds. Finally, let's talk about index funds. These are one of my favorites because they give you a piece of the biggest companies. Think Apple, Microsoft, and Amazon, all in one go. It's like a basket full of stocks from top-performing companies, and it allows you to invest in the overall market rather than betting on one company. Learning curve. Low. With index funds, you don't have to pick stocks. You just invest in a fund, and it does the work for you. No need to be a stock-picking genius. Passive income potential, moderate. Index funds don't pay high dividends, but they do give you steady growth. Some funds focus on dividend-paying companies, so you'll get dividends as a bonus. Tax efficiency, great. If you invest in an index fund through something like an ISA or a Roth IRA, you can avoid taxes on your earnings. Risk level low. Index funds are more stable because they're diversified. Instead of putting all your money into one company, you're spreading it across hundreds or even thousands of companies. Example: after 4 years, my $100 investment in an S&P 500 index fund is worth $179.57, a return of 79.57%. Index funds are one of the safest bets for long-term wealth growth. Okay, so let's wrap this up. We've covered individual stocks, REITs, crypto, gold, and index funds. Each one has its pros and cons. Some will make you money fast, some will help you protect your wealth, and others might help you generate steady passive income. But here's the bottom line. It doesn't matter how much you start with, just start. $100 might not seem like much, but with the power of compounding, even a small investment can grow over time. The most important thing is to get started. It's better to invest $100 today than to wait until you have $1,000. Time is your best friend in investing. So, what are you going to do with your first $100? Let me know in the comments below. Don't forget to like, subscribe, and share this video with someone who needs to see this. Let's build our wealth, step by step, one smart investment at a time. See you in the next one. Cash Queen out.